Ladies and gentlemen, we need to talk. Stop what you're doing, turn off the noise, close the other tabs. Because what I'm about to show you isn't speculation. It isn't theory. It isn't a maybe this could happen someday scenario that we've been discussing for years in the comments section. This is real. This is happening right now. And by the time the mainstream media figures out how to spin this story, it will be too late for most people to position themselves. The United States Treasury Department just executed the largest single-day liquidity grab from the Federal Reserve in modern financial history. We're not talking about billions with a B. We're talking about $500 billion with a $500 billion T. $500 billion moved from the Federal Reserve's balance sheet to the Treasury's general account in what can only be described as a financial emergency maneuver. And while this was happening, while the plumbing of the global reserve currency was being stress-tested to the breaking point, silver, that barbarous relic that the talking heads told you to ignore, gapped up $3.20 in overnight trading. Now I know what you're thinking. You're thinking, okay, the government moved some money around. They do that all the time. Why should I care? And that's exactly what they want you to think. They want you to believe this is routine. They want you to think this is just normal Treasury operations, standard fiscal policy. Nothing to see here, folks. Move along. But if you understand how the financial system actually works, if you understand the mechanics of what just happened, you will realize that we just witnessed the equivalent of a 5-alarm fire in the engine room of the USS Dollar, and the crew is throwing everything overboard to keep the ship afloat. Let me explain what a $500 billion Treasury draw actually means. The Treasury General Account, the TGA, is essentially the government's checking account at the Federal Reserve. When the government spends money, it draws from this account. When it collects taxes or issues debt, it deposits into this account. In normal times, the Treasury likes to keep this account relatively stable, usually between $300 billion and $800 billion, depending on seasonal flows and upcoming payment obligations. It's financial cushion. It's the buffer that prevents the government from bouncing checks. But what we just saw wasn't normal. According to the data that crossed the Bloomberg terminal this morning, the Treasury General Account spiked by $500 billion in a single 24-hour period. That's not a gradual buildup. That's not tax season. That's not a planned auction. That is panic. That is the Treasury Department calling the Federal Reserve in the middle of the night and saying, we need cash. We need it now. And we need more than we've ever taken before. Now, where does this money come from? Because the Federal Reserve can't just create $500 billion out of thin air without consequences, right? Wrong. They absolutely can, and they just did. But here's the mechanism that matters. When the Treasury needs to fill its account, the Fed has two primary options. Option one, the Treasury issues new debt, bonds, bills, notes, and the Fed purchases them directly or facilitates their purchase through primary dealers. This is quantitative easing under a different name. Option two, the Fed directly credits the Treasury's account through what's called a temporary increase in the supplementary financing program. Or they engage in complex repo operations that effectively achieve the same result, liquidity creation. Either way, we're talking about monetary expansion, we're talking about the printing press, we're talking about the debasement of the currency, and we're talking about it happening on a scale that makes the 2020 pandemic response look measured and cautious by comparison. But here's where it gets really interesting. Here's where the silver connection comes screaming into focus, because this $500 billion injection didn't happen in a vacuum. It happened at the exact same moment that the commodity markets, specifically the monetary metals, started exhibiting behavior that suggests someone, somewhere, knows that this currency debasement is accelerating beyond the Fed's ability to control it. Let's look at the timeline. At 8:47 p.m. Eastern Time last night, silver was trading at $28.63 on the COMEX. Normal? Boring. The usual overnight drift that we see in thin Asian trading hours. Then at 9:15 p.m., something happened. The price didn't tick up, it didn't gradually rise, it gapped. It jumped from $28.63 to $31.85 in less than 4 minutes. That's a $3.22 move. That's an 11.2% gain in 240 seconds. Now, gaps like this don't happen in mature liquid markets unless someone with very deep pockets and very good information decides they need to own a lot of something right now. Price be damned. In the world of technical analysis, we call this a breakaway gap. It's the kind of price action you see at the beginning of a major trend change. It's the market screaming that the old equilibrium is dead and we're searching for a new one. And the timing is just too perfect to be coincidental. Within hours of the Treasury executing this massive $500 billion draw, silver, the poor man's gold, the industrial metal that the banks have been suppressing for decades, decides to wake up and gap through every resistance level like they don't exist. You don't think these two events are connected? You think it's just random that the biggest liquidity grab in history happens on the same night that silver has its most violent upward move in 2 years? Let me connect the dots for you because the mainstream financial media won't. They can't. Because if they admit what's really happening, if they acknowledge the implications of what we're witnessing, the confidence game collapses, and the confidence game is all they have left. Here's what's really going on. The United States government is running a fiscal deficit that is mathematically unsustainable. We're spending $2 trillion more than we collect in taxes every single year. And that number is accelerating. The interest payments on the national debt alone are now over $1.2 trillion annually. That's more than we spend on defense. That's more than we spend on Social Security. We are literally borrowing money to pay the interest on the money we already borrowed. This is the definition of a debt spiral. Now, in a normal functioning market, when a borrower becomes this over-leveraged, lenders demand higher interest rates to compensate for the increased risk. This is basic finance. Higher risk equals higher required return. But the United States government cannot afford higher interest rates. If rates go up, the interest payments on the debt explode even faster, accelerating the deficit, requiring even more borrowing, which pushes rates higher still. It's a death loop. So what's the solution? The only solution for a government that has spent itself into a corner is to debase the currency. You inflate away the debt. You print enough money that the nominal value of the debt stays the same, but the real purchasing power of those dollars shrinks. You're stealing from savers, from bondholders, from anyone holding dollars, and you're using that theft to make your debt burden manageable. This is exactly what happened in the 1970s. This is exactly what happened in Weimar Germany. This is exactly what happened in Zimbabwe, in Venezuela, in Argentina, in every single country throughout history that tried to solve a spending problem with a printing press. And it always ends the same way. The currency collapses. Real assets skyrocket. And the people holding paper promises get destroyed. And this is where silver comes into the story. Because silver, like gold, cannot be printed. It cannot be conjured into existence by a Federal Reserve decree. It is a physical element with a fixed supply that has to be mined out of the ground at great expense. And throughout all of human history, going back 5,000 years, silver has been money. Real money. Money that holds its value when governments debase their paper currencies. The 3.22 gap in silver last night was the market waking up to the reality that the debasement is accelerating. Someone, likely multiple someones, large institutional players with access to real-time Treasury data, saw that $500 billion draw and realized what it meant. They realized that the Fed is back to printing. They realized that the tightening cycle is over. They realized that the only way forward is inflation. And they moved fast. They bought silver aggressively. They didn't wait for a pullback. They didn't try to nibble around the edges. They hit the bid with overwhelming force because they understand that when a currency crisis begins, the first rule is to get out of paper and into real assets. Now let's talk about what this $500 billion is actually being used for. Because the Treasury doesn't just draw $500 billion for fun. They have specific near-term obligations that require immediate liquidity. And when you look at the calendar, when you see what's coming due in the next 30 days, the picture becomes terrifyingly clear. We have approximately $750 billion in Treasury securities maturing in January alone. That's $750 billion in debt that needs to be rolled over, refinanced, paid back to the bondholders who are now demanding their money. In a healthy market, this rollover is routine. You issue new bonds to pay off the old bonds. The cycle continues. But we're not in a healthy market anymore. We're in a market where the largest foreign holders of U.S. debt, China and Japan, are net sellers. We're in a market where the Federal Reserve, which used to be the buyer of last resort during QE, is actively shrinking its balance sheet through quantitative tightening. So who's buying the new issuance? Who's stepping up to lend the United States government $750 billion at a time when inflation is still running hot and the credit rating agencies are making noise about downgrades? The answer is nobody. Nobody wants to buy long-dated U.S. debt at 4.5% when inflation is running at 3.5%, and everyone knows it's being understated. That's a guaranteed loss of purchasing power. This is why the Treasury needed the $500 billion from the Fed. They can't roll the debt in the open market at acceptable rates. So they're using the Fed as a bridge. They're using the Fed's balance sheet as a temporary warehouse for government debt. They're monetizing the deficit directly, which is exactly what they said they would never do after the 2008 crisis. And here's the kicker. Here's the part that should make every holder of dollars extremely nervous. This $500 billion is just January. We have the same problem in February, the same problem in March. The debt maturity wall doesn't stop. It's a treadmill that keeps accelerating. If they needed $500 billion to get through January, how much will they need for the full year? $2 trillion? $3 trillion? At what point does the market lose faith in the dollar's purchasing power? At what point do foreign central banks and sovereign wealth funds say, we're out. We don't want to hold dollars anymore. We want real assets. And when that happens, when the bid for dollars disappears and the world starts dumping Treasury securities, the Fed will have no choice but to step in and buy them all. They'll have to print whatever it takes to prevent yields from spiking and crashing the economy. We're talking about QE on a scale that makes 2020 look like a pilot program. We're talking about trillions of dollars of new money creation over the next 12 to 24 months. This is the end game. This is the moment where the 50-year experiment with pure fiat currency, with money backed by nothing but faith in the government, reaches its logical conclusion. And the market is sniffing it out. The silver gap last night was the canary in the coal mine dying. It was the early warning system telling us that smart money is rotating out of financial assets and into hard assets. Now, let's look at the technical setup for silver, because this gap doesn't just matter fundamentally, it matters technically as well. Before last night, silver had been trapped in a range between 26.50 and 29.0 for the better part of 6 months. Every time it tried to break out above $29, the banks would come in with their paper contracts and smash it back down. It was frustrating for anyone who understood the supply-demand dynamics. The physical market was screaming shortage. Premiums on coins and bars were through the roof. Delivery delays were stretching into weeks. But the paper price refused to acknowledge reality. Until last night. The gap to 31.85 took out every single resistance level in one violent move. It broke the 200-day moving average. It broke the 2023 high. It triggered stops and forced short covering. And most importantly, it created a new technical floor. In technical analysis, gaps tend to act as support once they're established. The old resistance becomes new support, which means if silver pulls back, and it probably will because nothing goes straight up forever, the dip buyers should be waiting at $29 to $30. But I don't think we're going to see $29 again. I think the $500 billion Treasury draw and the silver gap are the beginning of a much larger repricing event. And I'll tell you why. Because we're not just dealing with U.S. fiscal problems. We're dealing with a global sovereign debt crisis. We're dealing with Europe on the brink of recession, China's property market imploding, Japan trapped with negative rates, and a currency that's losing value against everything except the dollar. The world is drowning in debt denominated in dollars. And as the Fed is forced to print to fund the Treasury's deficits, as those new dollars flood into the system, they devalue every dollar-denominated debt instrument on the planet. They export inflation globally. And when inflation picks up, when people see their savings evaporating, they panic. They rush into hard assets. They buy gold. They buy silver. They buy anything that can't be printed into oblivion. And here's where the silver story gets really interesting. Because unlike gold, which is primarily a monetary metal held by central banks and wealthy individuals, silver is also an industrial metal. It's consumed in solar panels, in electric vehicles, in electronics, in medical devices, in water purification, in every single technology that defines the modern economy. And that industrial demand is inelastic. A solar panel manufacturer can't just decide to use less silver because the price went up. The panel won't work. The efficiency drops. They have to pay whatever the market demands. So we have monetary demand increasing because of currency debasement, and we have industrial demand increasing because of the green energy transition, and we have supply that's been flat to declining for the past 5 years. The math is simple. The price has to go higher, much higher. And the $500 billion Treasury draw, the thing that everyone is going to ignore or dismiss as routine, is the catalyst that's going to accelerate this repricing. Let me give you some specific numbers to think about. The global silver market is approximately 1 billion ounces per year of supply from mining and recycling. Demand is running at about 1.2 billion ounces. That's a 200 million ounce deficit. Now, that deficit has been filled by above-ground stockpiles, by inventories that were built up during previous years when supply exceeded demand. But those stockpiles are running dry. The vaults are being drained. If you look at the COMEX warehouse stocks, the registered category, which is the silver available for immediate delivery, it's down 65% from its 2020 highs. We're talking about less than 50 million ounces of deliverable silver backing a paper market that trades hundreds of millions of ounces every single day. The leverage in the silver market is insane. Some estimates put it at 201 or higher. That means for every ounce of physical silver that actually exists in the vaults, there are 200 paper claims on that ounce. What happens when everyone tries to claim their silver at the same time? What happens when the industrial users decide they don't trust the paper market anymore and they demand physical delivery? What happens when the $500 billion in new money creation starts chasing the same fixed supply of metal? The price doesn't just go up, it explodes. And we're starting to see the signs of stress. We're seeing delivery notices at the COMEX increase. We're seeing premiums on physical silver decouple from the spot price. We're seeing mints around the world report unprecedented demand. The US Mint, the Royal Canadian Mint, the Perth Mint in Australia. They're all struggling to keep up with orders. This is not normal market behavior. This is the early stage of a shortage. Now, I want to address the skeptics. I know there are people watching this who think I'm being hyperbolic, who think I'm fear-mongering to get views. And I understand that skepticism, because the precious metals community has been crying wolf for years. We've been saying the collapse is coming, the dollar is dying, buy silver now before it's too late. And year after year, the system has limped along. The dollar hasn't collapsed. Silver hasn't gone to the moon. Life has continued more or less as normal. But here's what you need to understand. Complex systems don't fail gradually. They fail suddenly. They appear stable right up until the moment they're not. It's called a phase transition. Think about water turning to ice. The temperature drops slowly, 1 degree at a time, and the water looks exactly the same. Still liquid, still flowing. And then it hits 32 degrees Fahrenheit and boom, instant phase change, solid ice. The same molecules, but a completely different state. The financial system works the same way. It can absorb stress and debt and money printing for a long time. It looks fine on the surface. The stock market keeps going up. People keep going to work. The grocery stores stay stocked. And then one day, one event, one piece of data, one $500 billion Treasury draw pushes it past the breaking point. And everything changes in an instant. I'm not saying that we're going to wake up tomorrow and the dollar is worthless and silver is $500 an ounce. I'm saying that we just crossed a threshold. We just saw the Treasury do something that signals they're losing control of the debt situation. And the silver market, which is the most sensitive barometer for currency stress, reacted instantly with an 11% gap up. This is your warning shot. This is the market telling you that the game is changing. And if you're sitting there with 100% of your wealth in dollars in a bank account earning 0.5% interest while inflation is running at 3.5%, you're losing purchasing power every single day. You're on the wrong side of the greatest wealth transfer in history. Now, let me talk about what happens next, because we're not at the end of this story, we're at the beginning. The $500 billion Treasury draw is going to have ripple effects throughout the entire financial system. Let's walk through the chain reaction. First, the $500 billion that the Fed just created has to go somewhere. It gets spent by the government on Social Security checks, Medicare payments, defense contracts, interest on the debt. That's $500 billion in new dollars entering circulation. Those dollars chase the same amount of goods and services, which means prices go up, inflation accelerates. Second, when inflation accelerates, the Fed faces a dilemma. Do they raise interest rates to combat inflation, which would crash the economy and make the government's debt payments explode? Or do they keep rates low and accept higher inflation? Based on what we just saw with this Treasury draw, they've already made their choice. They're choosing inflation. They're choosing to protect the government's ability to service its debt at the expense of the dollar's purchasing power. Third, as inflation picks up and the dollar weakens, foreign holders of Treasury securities start to panic. They see their investments losing value in real terms. They see that the U.S. government is prioritizing domestic political stability over the interests of foreign creditors. So they sell. They dump treasuries and rotate into other assets. Eurobonds, Chinese bonds, gold, silver, commodities. Anything that isn't a depreciating dollar-denominated IOU. Fourth, as foreign demand for treasuries declines, the Fed has to step in and buy even more. They become the buyer of first, last, and only resort, which requires even more money printing, which accelerates inflation further, which causes more foreign selling. It's a doom loop, a self-reinforcing cycle that feeds on itself. And finally, as this cycle accelerates, as it becomes obvious to everyone that the dollar is being systematically debased, the public wakes up. Retail investors, pension funds, insurance companies, everyone sitting on large cash positions realizes they need to protect themselves. They need to own real assets. They need to own things that can't be printed. And they all rush for the exits at the same time. This is when silver really takes off. Because when the general public decides they want precious metals, when Joe and Jane Average start pulling money out of their 401ks to buy silver coins, the physical market can't handle the volume. The dealers run out of inventory. The premiums explode. The disconnect between paper price and physical price becomes untenable. And the paper market, the comics futures market that has been used to suppress prices for decades, breaks. We saw a preview of this in 2020 during the pandemic. We saw premiums on silver coins hit $10 to $12 over spot. We saw month-long delays for delivery. We saw the paper price disconnect from reality. And that was just a taste. That was a small blip of retail demand during a crisis. What we're facing now is potentially much larger, much more sustained, because this isn't a temporary pandemic shock. This is a permanent shift in the fiscal trajectory of the United States government. The $500 billion Treasury draw is the proof. It's the admission that they can't fund the government through normal means anymore. They need the Fed. They need the printing press. And once you start down that road, once you cross the line from sound money to print whatever it takes, you can never go back. Because printing is easy, austerity is hard. Politicians will always choose the easy path. So where does silver go from here? Let's talk price targets. Because everyone wants to know, should I buy now? Is $31 too expensive? Am I chasing? And my answer is this. If you're thinking about silver in terms of dollar price, you're already thinking about it wrong. The question is not whether silver is expensive at $31. The question is whether dollars are expensive at 1/31th of an ounce of silver. And given what we just witnessed with the Treasury draw, given what we know about the fiscal trajectory, given what we understand about supply and demand dynamics in the physical market, I would argue that dollars are extremely expensive right now. Dangerously expensive. Hold at your own risk expensive. But since everyone wants numbers, let me give you some context. In 2011, when we had QE2 and the European debt crisis, silver hit $49 an ounce. That was with a much smaller money supply, much less debt, and much less industrial demand than we have today. If we just match that 2011 high, we're talking about a 58% gain from current levels. But I don't think $49 is the top this time. I think we go higher, maybe much higher. If you look at the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, we're currently sitting at about 90.1. Historically, that ratio has been closer to 60.1. If we just revert to the historical mean, with gold at $2,750, that puts silver at $44. But in times of monetary stress, in times when people are fleeing paper currency and rushing into metals, that ratio compresses even further. In 2011, it got down to 35.1. If we hit 35.1 with gold at $2,650, that's silver at $75. But here's the thing. I'm not saying this to pump your bags. I'm not saying this to generate clicks. I'm telling you this because the math supports it. The supply-demand fundamentals support it. And most importantly, the policy response we're witnessing right now supports it. The $500 billion Treasury draw is the signal that the Fed has capitulated. They're choosing inflation. They're choosing to destroy the dollar slowly rather than let the debt bubble pop violently. And in that environment, in a world where the currency is being systematically debased, hard assets are the only rational place to be. Not stocks, because stocks are priced in dollars, and if the dollar is losing value, then stock prices need to go up just to stay even in real terms. Not bonds, because bonds are promises to pay you back in depreciated dollars. Not cash, because cash loses purchasing power every single day that inflation exceeds your interest rate. Physical silver. Real metal that you hold in your hand or store in a secure vault under your direct control, that's the asset you want to own. Because when the confidence in paper finally breaks, when the public realizes what's happening, when the rush for the exits begins, physical silver will be unobtainable at any price. The dealers will be sold out. The mints will have months-long backlogs. The premium over spot will be meaningless because there is no spot market anymore. Just a bifurcated market where paper trades at one price and physical trades at a completely different price. We saw this in 2020. We're going to see it again. Except this time, it's not going to last for 3 months and then calm down. This time, it's going to be permanent. Because the underlying problem, the debt problem, the deficit problem, the money printing problem, isn't going away. It's getting worse, exponentially worse. The $500 billion Treasury draw is just the latest data point in a trend that's been building for years. The trend of fiscal insanity. The trend of living beyond our means. The trend of kicking the can down the road and hoping future generations will figure it out. Well, we're running out of road. We're approaching the cliff. And the silver market knows it. That $3.22 gap wasn't random. It wasn't technical. It wasn't driven by some hedge fund algorithm gone haywire. It was real money making a real bet on a real crisis. And that money is smarter than you. It's faster than you. It has better information than you. And it just told you exactly what's coming. So the question you need to ask yourself is simple. Are you positioned for what comes next? Are you holding assets that will protect you when the dollar loses 30%, 40%, 50% of its purchasing power over the next few years? Or are you sitting in cash and bonds and paper promises, hoping that somehow this time will be different, that somehow the laws of economics don't apply, that somehow the government can print unlimited money with no consequences? Because I can tell you right now, this time is not different. This time is exactly the same as every other time throughout history when a government tried to solve a spending problem with a printing press. The only question is whether you're going to learn from history or become another victim of it. The Treasury just tapped the Fed for $500 billion. Silver gapped up $3.22 in response. The writing is on the wall. The market is screaming at you. Are you listening? I'm not here to tell you what to do with your money. I'm not a financial advisor. I don't know your situation. But I am here to show you the data, to connect the dots, to explain what's happening in plain English so you can make informed decisions. And the data is telling me that we just crossed a line. We just entered a new phase of this crisis. And if you're not prepared, if you're not positioned in hard assets, you're going to watch your wealth evaporate in real terms while the nominal numbers in your bank account stay the same. Don't let that happen. Don't be the person who sees this video, understands the implications, and then does nothing. Because doing nothing is a choice. And in an inflationary environment, doing nothing is the same as choosing to lose money. The $500 billion Treasury draw is your wake-up call. The silver gap is your confirmation. The trend is your friend. And the trend is very, very clear. We're going higher, much higher. And the only question is whether you are coming along for the ride or watching from the sidelines as the greatest wealth transfer in modern history unfolds before your eyes. This is your moment. This is your opportunity. The door is still open, but it won't stay open forever, because once the public figures out what's happening, once the rush begins, you won't be able to get physical silver at any reasonable price. The window is closing. And that $3.22 gap you saw last night, that was the sound of the window starting to slam shut. Don't wait for $40 to wish you'd bought at 31. Don't wait for 60 to wish you'd bought at 40. The time to act is now. While you still can, while the dealers still have inventory, while the premiums are still reasonable, while the paper price still exists as a meaningful reference point. Because I'm telling you, 6 months from now, 12 months from now, we're going to look back at $31 silver and laugh. We're going to marvel at the fact that you could buy real money, physical silver, for the price of a nice dinner for two. We're going to shake our heads at the opportunity that was sitting right in front of us while the Treasury was lighting the fuse on the dollar. The $500 billion draw happened. The silver gap happened. These are facts, not opinions, not predictions. Facts. And the implications of these facts are devastating for anyone holding dollars and incredibly bullish for anyone holding real assets. So make your choice, but make it soon. Because the market doesn't care about your timeline. The market doesn't wait for you to be ready. The market moves when the data changes. And the data just changed in a massive way. The Treasury tapped the Fed for $500 billion. Silver responded immediately. The next move is yours.